Hi, Todd Pouliot, Gateway Financial. I just wanted to make a quick video today. Feel free to visit us at mygatewaymoney.com and you can book a time and we can talk about tax. But I think this tax strategy that I'm going to share with you today, and it's not necessarily just a tax strategy, it's a review and what is to come. And what I want to show you today is this is just for regular people. I think in our industry we talk about millionaires and multimillionaires and all the things, but this couple is retired. Their total income's about $62,000 with Social Security and everything. They have about $800,000 worth of assets, all in an IRA. These are genuinely the salt of the earth people that are first generation, able to not work on the farm, to work in a factory and have a retirement and live this kind of life. And I think they get lost in the shuffle a lot. And unfortunately, they don't get the right tax planning or tax help because they don't think that they have enough, or that they're somehow just lost in the shuffle. These are also the type of people who get sold products. And I think that's a big issue here, is they were sold some what's called a fixed indexed annuity, where it's about safety and it's a scare tactic sale. And they've missed out on about $250,000 worth of gain in the account. So they could have been millionaires. And that would have been an amazing achievement for these folks. And I'm not saying that's not going to happen to them in the future, but we need to remember there's so many people out there like this that need help. And you're going to love what I have to show you. So I'm going to share my screen. I always do in my videos. And again, I just record these videos. They're not polished. It's kind of a take thing. And I was working outside in the yard yesterday. So if I cough, I apologize. The tree pollen was a little high, but this is it. This is just a client, $62,000 worth of income, married, filing jointly, 10% marginal tax bracket. I mean, this just seems like there's not a whole lot to do. But boy, do we have a lot to do, because this is where I think a lot of people miss the point. Qualified and ordinary dividends, short-term and long-term capital gains, carry forward loss. This is financial planning. This is a great area where they've missed out on the past, but have so much opportunity in the future. This middle column is kind of the CPA column. All right, this is your marginal tax bracket. And what I love here is the effective tax rate at 2.52%. And I'm just going to zoom in because sometimes these numbers get a little bit small on screen. But in a way, I feel like that's almost too low. Well, aren't you supposed to pay the least amount of tax? Yes, you are. But paying the least amount of tax in 1 year versus paying the least amount of tax in your lifetime is a big difference. The big issue that I notice here, massive deductions by a percentage, because remember, they're taking the standardized deduction and they're also taking the enhanced senior deduction that was passed under the One Big Beautiful Bill. And that's why you see such a low tax liability. And that works. Yes, paying a low tax liability matters. However, let's look at some of the different things that are in here about 2026 that we really want to focus on. The conversion. Why do I want to do a conversion? And how should I do it? Because that's everything I've been hearing about. What I've done a couple different calculations: 35,000, 50,000, 60,000, 120,000, all very rounded numbers. But if you notice here, the client has an exceptional 4-year Roth conversion window. Why? Because they have an extremely low AGI, or adjusted gross income. And with this big deduction, very wide open for us to stay within the 10 and 12% tax brackets. And I've done a specific number of 97,000, and that 97,000 would be converted at a 14% blended rate. Remember, that's federal and state. This is including the state of Ohio, and that's why we chose these clients as a very specific number, because we do have an income tax here in the state of Ohio. Remember, the window closes in 2028. This is a very good opportunity to start now. The conversions amount. So many things that people ask me, well, isn't my Social Security going to be taxable? And yes, it is. There is this torpedo zone. That's why there's a 0% option, a 60% option, and a 97,000 option. These different amounts matter because we don't want to be in that 18% torpedo range. We want to possibly get out of that and do a 60,000 Roth conversion. The torpedo zone is explained here. It's not great to be in that zone, and it's okay. But that's why if you're going to do something, make sure you understand there is a difference between doing something part way, all the way, or saying no. That is an option as well. But all of them have pluses and minuses, and understand what those are. The conversion scenario, baseline, what they're doing now, no conversion. This will be the AGI for 2026. Really no change. The conservative, only 10%. We're going to fill with a 10% tax bracket. The AGI changes, correct. Yes, it does. And there is some additional tax, and that rate is 8.2%. We can go to the middle with just a very average, moderate one, 60,000. Again, the AGI. Then we move up to 13.6. And if you're that close and 0.4% in tax matters, do that 12. Fill it up, 97,000. Your AGI moves up to just under 150,000. Why is that important? Just wait and you will see. The Roth conversion, you're filling the brackets. Not all of it is taxed at 12%. Remember, a portion of that is only taxed at 10%. That's why those numbers work. The total tax liability on $147,000 worth of income is $11,518. That is a wonderful, wonderful tax bill. I would say that looking at it could be beneficial long term. So again, the things to think about. I made a decision, but what's next? Always think about what is the future. What is next? The modified adjusted gross income, enhanced senior deduction phased out at 150. That's the important line here. I don't think the line is about percentages and all the other different things in here. The line is the 150,000. Because of the $97,000 conversion, our modified adjusted gross income is just under 150. Now that is below the threshold, and it preserves the full $12,000 deduction. IRMA, we have plenty of headroom left in the IRMA. Net investment income tax, the NIT tax, Medicare premium tax, 250,000. 0% long-term capital gains rate. You remember up top when I said, hey, this is the place for financial planning? They could have paid 0% on long-term capital gains. Now that conversion is taxable. We have all this here, but just at that 0% threshold. This is only limited. We need to be very careful on that. So very cognizant where we're at. And the direct contribution well below that. So projections, deductions, and credits. Again, standard deduction plus the 65 and the enhanced senior deduction gives them that total of 47,500. We haven't removed that. That's the key. Be careful when you're doing these projections. Credits for Ohio, again, a temporary window is to 2025 to 2028. Please take advantage of that. Again, we don't really need to worry about IRMA. We don't need to worry about all the things that we've been targeting because this client is in a low tax bracket. We're not talking about a person that's making $250,000 a year working. We're talking about a retiree. That's why this plan works so well. 4-year plan. Let's just make a 4-year plan. 4-year Roth conversion. 97,000 annual conversion, approximately. The total converted during that time frame is $388,000 worth of conversion. The reason why this works is because you are creating a tax allocation, not just an investment or an asset allocation, but a tax allocation. The estimated tax between 54 and 58,000. The estimated blended rate is about 14%. Again, the big deal that I'm going to say again is federal and state, and I'm using Ohio. The remaining balance is about $412,000, plus whatever growth you got. We didn't want to add growth because we don't know what the market's going to do in the next 4 years. We could have a 20% correction in there. We don't know. So again, the big get for this client was the RMD reduction, about half of annual RMDs. He's going to have less forced income on Social Security. He is protected from the Roth, from the modified adjusted gross income. So that is not a relationship there we need to worry about. There's no tax on Roth, and it'll be tax income free for the heirs. This is an exceptional conversion plan for this client. I think it's wonderful. And I know what's happening next. You're going to say, Todd, why would I do this? What I'm never going to leave the 12% tax bracket. I want you to remember why. This is a married heterosexual couple. What happens? The chance of one of you living to age 90, if you're 65, is 50%. Men typically die before women. The widow's tax trap, that's the big one. When you have that tax trap, their surviving spouse, the income that doesn't necessarily go down, but the brackets are in half. And if that was still the case, and that spouse still has the full $800,000 IRA, the RMDs would be punitive and they would bump up into the 22% tax bracket, nearly double what they would pay on conversions today. That scenario is really defending the Roth conversion strategy, just that point alone. Point two is RMDs will grow whether you like it or not. If you did have an average 10% rate of return, it would be larger, but using a 5 to 6% growth rate, let's say at age 75, those RMDs would be $32,800 around. Age 80, $42,000. Age 85, $55,000. And age 90, around $67,000. That will push them beyond the 12% tax bracket. Also, the third issue is beneficiary tax rates. Remember, under the Secure Act, those inherited traditional IRAs must be emptied in 10 years. So if your beneficiaries are in the 22 or 24% tax bracket or even higher, that income is going to have to be paid out and will push them into higher tax brackets. The enhanced senior deduction creates a limited time discount. That's reason number 4. Take advantage of the opportunity that the One Big Beautiful Bill Act allows through 2028. This is a massive, almost free Roth conversion amount during this time frame only, and that opportunity to convert this much at 12% will go away. Roth dollars are worth more. That's number 5. $100,000 Roth IRA is worth more than $100,000 worth of traditional IRA. There's no embedded tax liability in Roth. And that will mean not only for you and for the growth for you, for your spouse that may live longer than you, and also your heirs for an additional 10 years after that. So the bottom line is the survivor's bracket will likely be 22%, the growing RMDs, and a temporary deduction window between 2025 and 2028 is unusually inexpensive. I hope I've explained to you the reason why Roth conversions work. And I'm doing this for the general population out there that's a retired, what we call mass affluent. They're not wealthy. They're not, $5 million. These are mass affluent people that have been sold products that might not have been the best for them. But, having a good financial planner, working with a CPA, working with an attorney, being a holistic provider to people matters the most. And I think that this tax plan really just hits the salt of the earth people that we love to work with. I hope you enjoyed yourself. Again, thank you so much. Get to know us more at mygatewaymoney.com. Book some time with us. Again, my name is Todd Pouliot with Gateway Financial, and we look forward and we're honored to service you. Thank you.